All right, so today we're going to dive into the market status, take a little bit of deeper dive into some of the implications of what's happening currently, but also take a look at more of a long-term perspective. Typically, we like to do that with guests that have, kind of these macro outlooks. I think you guys will like this one. My name is Paul Barron. Welcome back into Tech Path. I want to get into it today with Darius Dale. If you guys are not aware, Darius Dale has been on our show many times. He's CEO and founder over at 42 Macro. Great to have you back.
Always a pleasure to be here, Paul. Thanks for having me back. Appreciate you.
All right, so let's listen. If you guys have not had a chance to catch Darius before on our show, what I would do is invite you guys to jump over to his website, which is just 42macro.com. You can learn a little bit more about what they do in terms of their investment strategy and a lot of their own services. So check that out. We always love to plug our guest out there. So go visit and find out. And he's very active on Twitter as well. So check him out. All right, so I want to get into a few things here, Darius, with you. And that is when you look at the current status of major investment, we'll call them players in the market, whether you look at institutional capital or just high net worth individuals, a lot of people are starting to look at when is the right time to re-enter the market. You also have scenarios like this playing out right now. You've got Buffett, Burry, everybody kind of in this position of, hey, we think there's going to be this major crash. We are going to look at stepping away from the market and waiting for that right time. You look at that and the current situation of what's happening today. What are you seeing out there within your own data?
Yeah, so again, thanks for having me. So in terms of like where institutional investors are positioned, we have a litany of clients around the world who are all, institutional asset managers, insurance funds, pension funds, et cetera, from my, days on Global Wall Street, hence the suit in that photo. I have I'm pretty plugged in and understanding kind of where the institutional flows are. And it's pretty clear that over the last sort of 6 to 8 weeks, you've seen a little bit of an upside capitulation into the equity market that we're obviously correcting from now. But one thing I think we're over the last kind of 3 to 4 weeks, particularly since the Bank of Japan amended its yield curve control framework in late July, we've seen quite a bit of capitulation in terms of investors coming back in terms of treasury curve duration. And this is not just a treasury market phenomenon. This is happening globally across global sovereign debt curves. I mean, if you look at, some of the moves we've seen just week over week, in the treasury market, talking about 10-year yields up 25 basis points, UK gilt market, 10-year yields up 30 basis points, German Bund up 10 basis points, et cetera, et cetera. So you're seeing a lot of this return of bond market volatility. And I'll tell you, Paul, it's happening for two factors. One, economic resiliency in the US and Japan, which we can unpack. Two, inflation resiliency in the Eurozone and the UK, which we can unpack. But all those factors are combining to create a little bit more bond market volatility, which the markets are feeling right now.
NASDAQ had a little bit of a lift today, almost 3%, also playing into that. But okay, so a couple of things. We've had a chance to talk with a few other crypto analysts outside of the overall market side of things, and they have different viewpoints on, where this current market sets. If you look at some of the global, factors that are playing out right now, let's take a look at China and the EU in general, because those are kind of polar opposite stories. Talk to me about which one has the most potential impact of what's happening here in the U.S.
Yeah, so I would argue in terms of what's happening here in the U.S., it's very clearly the sticky inflation story that we continue to see in Europe. If you look at core inflation in the Eurozone coming in sticky at 5.5% in the most recent month, you have core inflation in the UK coming in sticky at 6.9% in the recent months, surprising consensus estimates to the upside. That's creating bond market volatility and expectations for not only more tightening in those localities, the ECB, Bank of England, but actually delaying the rate cuts that are currently priced into forward curves as well. And that's obviously a spillover impact here. But I would argue the number one thing that's causing problems in the U.S. equity market in the recent weeks is the resiliency of the U.S. economy, because ultimately it's pushing out the expectation that the Fed's going to be able to cut interest rates anytime soon.
Interesting. Summary of Fed minutes right here. Most officials still see the need for higher rates. This came from Kobeissi letter. Officials worry a little bit about over tightening. They see kind of tighter bank credit conditions. We've kind of expected some of that. No recession in 2023. We still are getting that indicator from the Fed. And then the one that I'm still most concerned about is the CRE situation, commercial real estate, around both the value in its current situation. I've been talking to a lot of real estate people here in Miami, and Miami is typically one of those markets that rarely gets affected by what happens here in the U.S. And abroad outside of maybe Los Angeles or even New York. but now Miami also starting to feel the pinch around CRE. With all of those things and based on the Fed minutes, where do you feel like this is going to push what we'll see in the coming months coming out of the Fed itself?
Yeah, so in our view, we think by the end of the year, we're going to be having a different discussion around inflation. Recall that inflation has been trending lower really since the fall of last year in a pretty spectacular, albeit immaculate way. We've been calling it immaculate disinflation amongst Wall Street participants because we understand that there's really no time series history or evidence to suggest that we should be seeing these types of positive inflation outcomes ahead or not in a recession. Typically, what happens is you get the breakdown in inflation several quarters, or a couple, 2 to 3 quarters after the recession begins. And so clearly we're not in recession. The economy seems to be booming, certainly being resilient. And so from the perspective of the Fed, I think by the end of the year, you're going to have a couple things happen. Right now, we have zero incremental rate hikes priced into the Treasury curve. I think that's wrong. By the end of the year, it's probably likely that we're going to start to see inflation stabilize at levels that are unpalatable to the Fed relative to their price stability mandate. And actually, let me take that back. I don't want to be too specific about December 31st, but I do believe in the next 3 to 6 months, the inflation narrative will evolve from immaculate disinflation to sticky inflation because the economy is showing resiliency and that's persistent.
So you feel like it's still going to hold. We're not going to see a full drop off of inflation to where Chair Powell is wanting to go to a 2%. This gets back into theories. Many people have talked about 3% more likely as a potential. What do you think is going to be that new target zone? Do you think the Fed is just going to do everything they can to still move to that 2% target zone, or do you think they're going to have some sort of acceptance slightly above that?
Well, you can make the case that they already kind of are, right? Like the reaction function is certainly downshifted to a one that's a little bit more asymmetric, or not asymmetric, a little bit more, symmetric in terms of responding to shocks of growth, shocks of inflation. Clearly, inflation is still in the driver's seat, but it's no longer in the driver's seat the way that it was 6 months ago when they were hiking, 75 basis points at a time. To answer your question, I do believe, so the one thing, this thing about inflation cyclically and secularly, real quick on the cyclical side, we still will see that there's a considerable amount of downside momentum in the time series, particularly when you analyze inflation through the lens of the sequentials, like 3-month annualized, 6-month annualized. It's going to drag the year-over-year time series for things like core PCE, super core PCE, trim mean PCE inflation down over the next few months. That we suspect that'll probably conclude in the next 3 to 6 months. From a secular perspective, this is where I think it really gets interesting and why we've been appropriate to be bearish on bonds all year. And the reality is a couple things. One, the Fed's going to have to change its 2% inflation target. We run a very sophisticated dynamic factor model that we've been presenting all across global Wall Street for the past few years, just sort of describing all the different changes that have happened in the global economy from a DSG perspective that suggests the underlying trend of core PCE inflation has migrated from around 1.6% to 3%. Now, that doesn't sound like a lot if you're talking about cryptocurrency or you're used to explosive logarithmic moves, but the reality is the Fed has a 2% inflation target. And so if the trend in the time series is persistently above 2, it means they're going to consistently be leaning against the investors, consistently be leaning against the economy. And I don't think that's politically palatable in a fourth turning society. I think they're going to have to revise their inflation target because ultimately they're going to be the ones responsible for gobbling up the $1.5 to $2 trillion budget deficits we can see as far as the eye can see.
Yeah. What do you think, Darius, would be the trigger for Chair Powell to say, or in general? I mean, I know this is more of a committee when they get into the FOMC meetings, but really the strategy that's done by looking and analyzing a lot of data coming into those meetings to be able to determine where their target zones are going to be. What is going to be the critical factor in the next 6 months to say 12 months that would reshift their thinking? Is there anything you would be watching for right now?
Yeah, financial stability. We saw it in March, right, with the regional bank saga, Silicon Valley. First Republic really struggling, effectively going bust. Financial stability concerns, when they become at the forefront, they become the only thing that matters. As long as we don't have financial stability concerns, we're talking about a Federal Reserve that can be quote unquote data dependent and drive monetary policy looking in the rearview mirror, which is what they've been doing really since March of last year. So I don't suspect that's going to change unless we see a significant bout of cross-asset volatility, a spike in bond market volatility, a spike in currency volatility that requires balance sheet expansion some way or somehow to get them, to kind of tone that down.
We've had you and Dr. Jeff Rosh from Vail Sharks Capital on before, kind of in a panel where we've done some analysis. I want to bring up a tweet here from Jeff. This is kind of his unpopular opinion, quite different from last decade of zero interest. other easy money policies, higher bond rates, actually more normal and healthy for the world's economy. As yield curve steepens again, I expect it's going to do so relatively at higher levels. Do you feel like that is still the case right now? What's your opinion?
Yeah, so I generally agree that we're making a series of higher highs and higher lows with respect to bond yields. I mean, just citing the analysis that I just put forth in terms of our structural inflation model, bond yields have to go higher. And there's
Yep.
a couple of reasons why they have to go higher in addition to that. We're coming from a ridiculous starting point in terms of price. Everyone's concerned about the valuation in the equity market, traded 20 times forward multiples, 35 times trailing multiples, all that stuff. People are freaked out about that, tightness of credit spreads. But the one thing that just really freaked me out as a more of an institutionally focused investor all year has been the perfect pricing we've seen in the bond market that's coming unglued. You look at term premium, which is the excess return you get for rolling over or for taking risk out on duration as opposed to rolling it over on that same time horizon. We're at minus 60 some basis points. That's not an all-time low, but it's down from like 500 basis points in the early 1980s. So that can go way higher. You look at inflation expectations, they're right around 2%, anchored at 2%, which is what the Fed wants. But the reality is, I just said the probability of it being 2% is low given our secular inflation model. And then number three, you have this sort of supply demand imbalance in the context of institutional capital allocators. If there is no recession, why in the hell would you, or sorry for part of my language, but why in the heck would you chase an inverted yield curve that could easily steepen on you just to sort of get back in line with what's happening in the real economy, which is exactly what I think is happening.
Yeah. All right. So I want to. Okay. I'm kind of in agreement with that to a certain extent. Obviously, there's some factors that play into this from a global aspect. One of them is actually referencing your tweet right here: economic situation in China, unmitigated disaster, July retail sales. We showed a little bit of this data earlier in some shows: industrial production, fixed assets, investment, all slowing and missing consistency. All right. So big problems in China right now. With this being a factor, obviously, China and its GDP and also its effect on other G20 nations, how big is this in terms of especially in the US markets right now? How big of a deal is this right now?
It's a big deal, but it's also not a big deal. It's a big deal in two ways, right? There's a big deal in the sense that if China falls off a cliff, we know it's going to have a big negative headwind to the global economy. We don't think China's going to fall off a cliff. In fact, if you look at, I think we do as good as a job as sort of researching anybody in China, not named China or Beige Book, with my friend Leland Lamilla over there. In terms of all the data analysis that we're tracking in China, it's very clear they're slowing. It's very clear that they're unlikely to meet their 5.5% GDP target. But they're not going to meet it by a substantial amount. Growth's not going to be 2.5% or 3%. We're talking about coming in maybe 4 to 4.5%, and maybe that's the new structural trend rate of Chinese growth. This 2023 has been all about investors right-sizing their expectations for the Chinese economy. I think we were the only person on Global Wall Street back in the winter or early part of this year saying, hey, without a meaningful large-scale fiscal stimulus program, which they confirmed they would not do on March 3rd, the Chinese economy was going to reopen into the structural liquidity trap that it was mired in pre-COVID. People forget that in 2019, China's economy looked exactly like it's looking right now. And so without that fiscal stimulus, which we obviously did not get, it's very likely that we're going to continue to be in an economic malaise. That's bearish at the margins, but it's not this real negative thing where like China's falling off a cliff and dragging down EM and dragging down Europe and ultimately dragging down the US, which rarely ever happens. So we're not too concerned about it, but it is a factor. Dispersion, Paul.
Yeah, exactly. Yeah, exactly. I want to look at, okay, so there's a couple of opinions right now from, I would say, some of the key players in the markets right now. They're continuing to look at some of the analysis around blockchain, obviously around crypto, which is mostly what our show talks about. But I always look at the macro factors, which is why we love to have guests like you guys on, because I feel like all of this is tied together. And when you look at, there's two clips here. I'm going to show one of Cathie Wood. We did an analysis on something she was talking about. And then I'm going to go to a clip that you did with Anthony Pompliano. So I want to play this first clip for you. Let's go over to this one. We'll hit play here.
Given our on-chain analytics, we're on the bullish side. We're probably, if there's going to be a break either way, it will be a breakout to the upside. And it's very volatile, of course, as we all know. But higher highs and higher lows means we're in a secular bull market.
All right, so she's talking secular bull market here, potential. simply meaning, for many of you who are watching for the first time, longer time zones in terms of being able to get to what we think is going to be that new area, whether you're in securities or if you're in some of these projects around crypto in general. So obviously, ARK, huge investor in Ethereum, Bitcoin, and other technologies around blockchain. When you look at her strategy and what ARK is doing, how do you, first of all, do you feel like that is most likely the track we're talking about right now, 2024, later 2024? Because I want to get into the happening here on some statements you made about this. What are your theories around this?
Yeah, so I mean, I think the halving is definitely going to matter, but I think it's probably going to matter more on the other side of the halving, and particularly once we get more, clarity on the regulatory front from an institutional allocator standpoint. I assume the ETF is going to get approved. This is BlackRock we're talking about here, so move on. Nothing to see here. That thing's getting approved. It's just a matter of when, not if. And so, if you think about, we've talked about with respect to, you referenced my visit with Pomp. The Bitcoin price is generally very volatile leading up to halvings. There's typically multiple 20% corrections. There's typically one or two kind of 40% corrections. And this isn't consistent across Bitcoin history, price history leading up to halvings. I think we've had 20% correction already this year. I think we've had another like 10 to 15% correction. I suspect there could be another 20% correction at some point over the next, call it 3 to 6 months leading up to the halving. I don't want to be specific on when that's likely to occur, but a couple things we do know. We know global liquidity is declining, has been declining. I think I was the only person in the world who called that out in real time in April when it inflected lower. It is continuing to trend lower. And this is why when we said, hey, book gains at 30,000 Bitcoin and the year-to-date high at Bitcoin at that time in April, that was an appropriate call because our analysis, our global liquidity proxy, and all the research that we do on that on the global liquidity front was saying, hey, this is getting worse, not better now. And it continued. Yeah. It's gotten worse since then. We're not going to get a big positive shock to global liquidity between now and let's call it the other side of the recession that we're likely to experience at some point in the first half of next year. And so we can sort of put that to bed from the perspective of Bitcoin. So I agree with Kathy in terms of the longer term outlook is very bullish. I have a 100,000 price target by December 31st, 2024. I put that out there and I still believe in that. But the path to getting there, in my opinion, is just going to be rocky. It's not going to be this linear bull market recovery that many crypto investors got, kind of suckered into going back to 2017 and 2021.
Yeah. Okay. So there's a couple things that obviously lie in the path of getting to those kind of numbers for that. One, of course, is going to be a Bitcoin ETF. You just mentioned a little bit about BlackRock. This is kind of a pretty much a done deal, or you feel like it might be.
It is.
You look at, okay. I like that. I like that confidence, man, because I'm still on the fence about this, of course, But I want to show something here from FundStrat's Tom Lee. He was on CNBC, and he basically said, hey, listen, if this spot ETF gets approved, he's looking at, Bitcoin seeing some pretty major shock appeal. Now, I look at this and I say, all right, will we actually see a true impact on Bitcoin if a spot ETF is done? Because I'm starting to feeling less and less that we would see significance. We saw the EU, granted the EU is a very small fraction of overall ETF participation globally. The US is the major market here.
Yeah.
But even if it's a BlackRock, what is your theory? Do you think that's going to cause a major response from the markets in general?
Yeah, because one, ETF is a tax efficient vehicle that allows not only institutional allocators, but also RIAs, et cetera, to find a place to park their assets. But I also think it's not just the availability of the product, it's also the demand for the product, right? You have the world, the large swaths of the institutional investment community, large swaths of the registered investment advisor community are sitting there in some form of like a hybrid 60-40 portfolio with a ton of duration risk. But the reality is they're all on the same side of the boat. And we're looking ahead to a decade plus of, structural budget deficits in the $1.5 to $2 trillion range. And that's excluding any recession that might happen that might cause budget deficits to be higher on a trend basis. But that's also inclusive of the fact that going back to our structural inflation model, we're talking about inflation that's likely to could be almost double what it was on a trend basis prior to this most recent decade. So I think the demand for fixed income type securities, certainly on the long end of the curve, is going to be structurally lower than it has been in recent years. And as a function of that, investors are going to have to find somewhere to reallocate those assets. We run a systematic 60-30-10 portfolio construction process for our clients here at 42 Macro, with the understanding that If you just take out 10 of the 40, you can beat the 60-40, and you will beat the 60-40 because we're coming from a ridiculous starting point of perfect prices on the long end of the curve. That's just, it's going to struggle for a long period of time, in my opinion.
So, Darius, do you see enough of your own client interest? You obviously see, what's happening within just the institutional finance areas as well, and especially around the demand, because you're alluding to there could be a lot of pent-up demand here for an ETF asset. In your opinion, if you look at what the current status of, based on what you know, kind of the trends that are tracking the market, you feel that this is a major event for Bitcoin as a whole?
I don't
Not
feel
just one
that
of those meh.
No, I don't feel that the launching of the ETF is a major event. I feel that the regime that we've entered into, and I don't believe that we are entering the regime now. We've entered the regime, 2 years ago, which
Right.
is no, 3 years ago, really, the fiscal largesse regime. We've went from an era of monetary dominance to an era of fiscal dominance. And what that ultimately means in asset allocation terms is that the investment community is way long too many bonds. They're going to be forced, and I'm talking not the crypto community, I'm talking the institutional investment community.
Yeah.
Those people at the margins for the next decade plus, as long as we're in this high budget deficit, and it's not just US, it's global, high budget deficit, fourth turning, high inflation environment, they're going to be looking around for alternative assets. And it's not all going to come the day they launch the ETF or the ETF gets approved. It's going to be a persistent, steady stream of flows, one by one, as investors get more and more comfortable with the idea of taking this kind of risk.
You talk about alternative assets. Let's jump over to Ethereum for a second. PayPal stablecoin for Ethereum. There's some analysts out there are looking at this could be a massive push here. We've also seen some indicators that could be with an ETF happening for Bitcoin, possibly. We could see maybe an Ethereum ETF coming in right behind it. When you look at that being on Ethereum's basis, what are your thoughts of whether or not we'll see those kinds of market actions, in the coming months and years after what we'll see from a Bitcoin ETF?
I'm sorry, what do you mean by market actions? Like decentralized
In reference
finance?
well, in the sense of one, ETH growing because we're seeing so much activity within the blockchain itself, and then the move to an actual Ethereum ETF.
Yeah, for sure. Absolutely. It's all going to come. I think if we're having this conversation August 17th of 2030, there will be an Ethereum ETF, a Solana, or maybe not Solana, but there'll be a bunch of ETFs, right? Because what happens in finance, what happens in every industry, right, is people innovate towards the demand. Where they see demand growth, they innovate in that direction. And ultimately, I believe that the demand growth is coming out of the long end of the fixed income market and into the alternative investment products, whether they be real estate, whether they be sort of digital assets, whether they be farmland, and who knows. We are in an environment where it pays to have these types of assets in your portfolio relative to the paper assets that we a lot of us got paid on for the last decade, or really the last 3 decades.
Yeah. All right. So other aspect of that, obviously, PayPal stablecoin launches. That in itself, very strong indicator. Your thoughts on, especially if you look at just the growth of what stable demand is. I was looking at Jamie Coots here. Emerging markets, importance of stables of paramount. Still seeking massively inferior to Bitcoin, obviously. But you look at a lot of demand globally, mostly from emerging markets. And then you have the legislation potentially that is right here on the verge of potentially going through here in the United States if we do get a stablecoin bill passed. How big of a deal is that for institutional finance, or is it a big deal at all?
In most of these countries, I mean, I'm learning a bunch of, with the exception of Singapore, and maybe UAE, most of these are current account deficit countries that need investment flows to grow. So they're not going to be the large source of demand for these types of products. The demand is going to come from current account deficit or current account surplus nations, net international investment creditor nations like Japan, like Singapore, like the Asian countries, like some of the Western European countries. And then obviously we have a deep pool of capital here in America because, well, we're still in the dollar reserve system and we get the benefit from that. So if you want to talk about flows, it ain't coming from Nigeria. Nigeria is not going to take Bitcoin from 30,000 to 100,000. It's the US, it's Europe, it's Asia, it's those investors.
So, but in reference to just stablecoins in general, you feel like this is a major adoption from people moving out of cash into stablecoins and using stablecoins as, with cash obviously as a reserve asset?
Perhaps. I mean, we got the BRICS currency thing coming up on September. I think there's a lot of movement because the world is frustrated with the dollars, but the reality is I think I've done a decent amount of work on this throughout my career, and certainly in the last couple of years, in response to some client inquiries. And the reality is, I keep coming back to the same point. What are you going to replace the dollar with? Right?
Yeah.
That's like, we can talk about stable coins, we can talk about all this other stuff, but what we really are talking about is a world that's frustrated with the US dollar. And the reality is, until we find an incredible solution for US dollars that's not going to blow up the world or create significant consequences, a la what we saw last summer and last fall for a lot of investors, they're kind of stuck with it.
Yeah. I was looking at the Dixie here, just looking all the way back into October of 22 down to where we are here. Now, granted, this is on the daily, but we've seen a lot of movement here over the past few weeks.
Yeah, a few weeks, yep.
Within that, though, when you look at the power of the dollar and what's happening with BRICS as a whole in general, obviously, I think it was Morocco just joined in as well. So we've got another one coming into the BRICS. How much of a global impact do you feel like that is for a global reserve, to whether it is going into a gold standard again, or do we see the dollar continuing to hold the power position?
This is a very interesting question, one I still have yet to really truly wrap my head around. I don't really know if anyone does. I've been listening to Jim Rickards, who's a very big expert on this subject about this, and so he's been kind of my guiding light there. But I'm trying to do my own research on this, and I struggle with how this is really truly going to impact things from a reserve standpoint. We know the dollar reserves have been declining for decades. That's not the issue. What's really what's changing here, in my opinion, is the incremental demand for dollar reserves. The problem is, so everyone thinks that like folks are like, okay, well, China can trade with Russia and Brazil can trade with China and India, and they don't have to settle in dollars. That's fine. These people no longer need dollars. But don't forget, the U.S. is the primary source of demand for most of the global economy. And so we are still going to be, exporting dollars back to a large swaths of the global economy that need to get recycled somehow, some way, or some fashion. So I don't see this as a short-term material credible threat to dollar hegemony. But longer term, what it ultimately means is that process of declining share of dollar reserves might actually speed up to the downside. You might get a little bit of a third derivative acceleration there, or a second derivative acceleration.
Well, and it gets into scenarios of just diversity, and what many people will do in terms of the assets they're holding, and they'll just get much more flexible in terms of the type of things they are holding. Whether you're a Bitcoin guy, gold guy, a dollar guy, or looking at more risk assets out there. So a very interesting time for sure. Darius, it's always fun having you on for sure.
Can I, before we go, I was going to say, you mentioned something, whether you're dollar guy, gold guy, don't be a guy, be a make money guy. Don't be a guy, just make money. If something's going up and it has a fundamental reason for going up, buy it. If something's going down, a fundamental reason for shorting it, short it. Call it a day. Don't get emotional about this stuff. All we're trying to do is learn, educate, and make money. If you try to make it more than that, you're going to lose a lot of money.
Yeah, for sure. Again, guys, make sure and check out 42 Macro. You guys are going to love what Darius does over there. And Darius, always great having you on the show. Thank you so much for stopping in.
We appreciate you having me, Paul. See you next time.
All right. Okay, so you guys are tuned in right now. We've got some additional content coming out for you today, so make sure and stick around for those. I'm not sure if we're going to do one live or what's going to happen there, but the way to catch our lives is, of course, subscribe to the YouTube channel, hit that little bell, you'll get notifications. But also another way to catch into additional content is over in our Diamond Circle, and the best way to do that is click the link down below. You can join, it's free. We do a podcast over there, some additional research, some of the stuff that we do and build out all of our shows on are usually released over on the Diamond Circle, so it's just additional content for you guys. If you want to catch me, it's out there on Twitter @PaulBaron. We'll catch you next time right here on TechPath.